Lately, the stock market feels like the weather app said sunny, but the moment you stepped out, bam! Thunderstorm! Every major headline is screaming doom. CNBC, Bloomberg, CNN, take your pick. But here's our golden rule: don't invest based on panic. Invest based on data. News is a drama queen. Focus on the real stuff: fundamentals, numbers, and yes, your mental health. Market turbulence didn't come out of nowhere. Smart money started moving quietly back in January. Those mega growth stocks that seemed invincible, yeah, they started looking a little shaky. And where did the money go? Defensive plays like consumer staples, utilities, REITs, healthcare, cash, gold. Translation: while some were still chasing highs, the pros were already shifting teams. Even the Magnificent Seven are no longer so magnificent after gaining 111% in 2023. They've already dropped 20% in 2025. Tariffs have serious market impact. History proves it. 1930 tariffs? Market crashed 28.5%. 2002 steel tariffs? Down 23%. 2018 China tariffs? S&P dropped 6.2%. On average, in the first year of a new tariff wave, the S&P 500 falls 14.5%. How long will this correction last? Looking at data since 1980, a real correction hits about every 3.2 years. Lasts 173 days. Average drop of 25%, median 20%. We're 46 days into the current pullback, so if the averages hold, we might hit bottom around August and then see a bounce. Rate cuts coming? Here's what markets expect. No rate change in May. Possible cut in July. If we do see a cut in July, right as the correction bottoms out, hello rebound. Investing wisdom time. The best days often come right after the worst ones. According to JP Morgan, 7 of the 10 best days in S&P 500 history happened within 15 days after the worst ones. Sell out in fear, and you could miss the rebound party. Time to bail or time to buy? People keep asking, should I sell everything now? Short answer, nope. This is prime bargain hunting season. Check this out. Since 2010, whenever the market fell 15 plus, if you bought the top 10 quality stocks and held for 2 years, 117% average return. Even if you were lazy and just bought the S&P 500, nearly 50% return. We're more than 15% pullback right now. Smart money's loading up. Are you? How to find unfairly punished gems. A lot of great companies are down 20%, 30%, even 40%. But it's not because their business is broken, it's just market mood swings. These stocks often still have strong fundamentals, solid profitability, much more attractive valuations now. First up on the growth train, Applevin. This one's been a hot topic lately. Market cap, a casual $74.6 billion. Officially, it's in the IT sector, application software, but really, it's an AI-powered matchmaking service for digital ads and the people they haunt, I mean target. The numbers? Oh, they're spicy. Revenue growth, plus 43, EBIT growth, 189%, while the rest of the sector is puttering along at 10. Free cash flow, up 61% versus 15% for the rest of the crowd. Basically, this company is sprinting past its competition while carrying a backpack full of money. The stock's valuation? Surprisingly solid, given all that A+ performance. Now, yes, there's drama. Some short sellers like Muddy Waters or Fuzzy Bear, seriously, are these research firms or cartoon villains? Have been throwing shade. They drop reports, sometimes full of half-truths, sometimes just nonsense. But here's the kicker. 19 analysts have raised earnings estimates recently. Only one said nah. So yeah, we're not losing sleep over the short reports. Also worth noting, Applevin recently said, hey, what if we bought TikTok? Markets were like, that's bold, and the stock popped 10%. Next, Brinker International. Aka the Chili's people. Yes, the house of triple dippers and affordable fajitas is crushing it. They also own Maggiano's Little Italy, because apparently, they do Italian too. Market cap, $6 billion. Sector rank, number 1 in restaurants, number 4 in all consumer discretionary. And get this, 1/8 to stock rally in the past year. That's not a typo. While other companies were trying to remember how to spell inflation, Brinker was out there going viral on TikTok and rebranding like a champ. They even lowered food prices during inflation. Who does that? Now let's nerd out. Price to earnings growth ratio PEG 0.5, a 64% discount versus the sector. Long-term EPS growth 37.6%, that's 233% above the industry norm. The overall valuation is technically a C, but don't let that fool you. When everything else is in a plus, that looks more like a steal than a slip. Also, 20 analysts recently upped their forecasts. 0 lowered them. 0. Zilch. Nada. Analysts love it. Customers love it. TikTok loves it. Honestly, what's not to like? Third, TG Therapeutics. Science Squad alert. These folks are doing the hard stuff treating B-cell diseases, including multiple sclerosis. Not sexy, but super important. And they're leaders in space. Now for the mind-blowing numbers. EPS growth, 179%. That's 1,169% better than the average healthcare company. Yes, you read that right. Add in 5 upward analyst revisions, only 1 down. And across the board, their quant ratings are lighting up like a Christmas tree. Wall Street is basically whispering, strong buy, and who are we to argue with 179% EPS growth? And last but not least, Lifetime Group. You've probably seen their Lifetime fitness clubs. They're those swanky gyms that look like hotels and have smoothie bars fancier than Starbucks. Market cap, $5.9 billion. Industry, number 1 in leisure facilities, number 6 in all consumer discretionary. Basically, the Bianca of gyms. They've got 175 clubs across the U.S., 5 million members. A killer post-COVID comeback story. During the pandemic, gyms got hammered, but Lifetime came back swinging, partly by ditching the whole buy the land and build model. Now they partner with landlords. It's like going from buying your own yacht to chartering one that already comes with a captain. Smart and budget-friendly. The numbers. EPS growth, 59%, 624% better than sector median. EBITDA growth, 18%, 283% above industry. PEG ratio, 0.4142% discount to the sector. Valuation score improved from DOD plus recently. Sounds meh, but remember Wall Street's valuation grades can lag behind the real glow-up. Applevin is the AI ad whisperer with TikTok dreams and killer fundamentals. Brinker is flipping burgers and flipping expectations, one viral triple dipper at a time. TG Therapeutics is curing serious stuff and growing like a weed. Lifetime is where luxury fitness meets genius budgeting. These 4, definitely worth a spot on your radar and maybe in your portfolio too. Quick recap. The market's on clearance sale, grab your cart. Don't obsess over how much a stock's drop, think about how much it can rise. The winners? Calm minds and patient hands. History is clear, after every downturn comes a rebound. This isn't a disaster, it's a limited time discount. So don't run scared. The smart ones are already buying low, getting ready to ride the next wave up. If you like our updates, don't forget to subscribe, hit like, and turn on notifications. See you in the next one.